Welcome to TheoTrade. This is Don Kaufman. It's July 19th, 2023. Just about 18 minutes after the cash close here on this Wednesday afternoon. Given a little time for Tesla to come out with its earnings, Netflix. Nevertheless, the bulls hit the bid. Look, the rally has gone on. Right now in the after hours, the Nasdaq is down 28 handles. It's been a while since we've actually had to say that the Nasdaq closed in the red, but really, 28 handles, that's for the most part in my book, massively unchanged. Let's start to break down just a little bit of the after hours trade and then just jump into kind of the week at large and some really critical aspects that I see going on inside of this marketplace right now. First and foremost, as I alluded to, earnings have come out, and these are the first big, if you will, tech earnings. Netflix slipping a bit to the downside, but look, it's never over, okay, until the conference calls, right? Order flow has not necessarily played out here. The most important thing when it comes to earnings, I mean, really what I look at, the expected move. There's just no question about it. The expected move is what matters. And in this particular case, you have a $477 product with approximately, let's call it a $43 expected move. Actual move right now? Well, this is right here, right now. And again, we're only 20 minutes after the earnings have come out. Stock's down about half the expected move. It's about 20 bucks to the downside. What does it mean? Frankly speaking, absolutely nothing. Because really, it doesn't mean anything, okay, until some of, again, that order flow has to play out. And most of that's going to happen during the conference call, during early trade tomorrow. In my book, I mean, if you look at the share price of Netflix, this is actually a huge win at this point. I mean, look, we're not even trading back to where we were, I don't know, yesterday, for example. Next on the docket, you cruise over to Tesla. Tesla, which hadn't done that much the first few months of the year, a little lackluster, was only up 50%. Okay, pretty much hit it into high gear 2 months ago. The things exploded to the upside. What are we looking at right now in the after hours? This is kind of crazy because Tesla, $291 stock, approximately a $22 expected move. Right now, unchanged. Unchanged, the earnings are out. Clearly, though, the conference call has yet to have happened, and that's going to be critical. I mean, this has been one of the dominant stocks, okay, inside of the rally, and that's what I'm talking about with the bulls hitting the bid, okay, is stocks like, Tesla. Now, on this day, okay, you can focus all you want on Nasdaq and what the Nasdaq's doing, but in very large part, one of the critical areas, okay, and you cannot overlook this because when I say a critical area, I mean, hands down, the most important thing that you can look at today, expected move in the SPX. And this is something I just allude to all the time. Like every Wednesday video, I'll talk about expected move, but it's especially critical when we're sitting on it. And it feels like, oh man, almost every week I've come in here talking about expected move because that's what the marketplace comes down to. And one of the things that's very apparent is, well, we are literally sitting on the upper edge of the expected move. The expected move this week was plus or minus approximately 56 bucks. Okay. When I say expected move, that's the option market handicapping forward risk. So last Friday at the close, we look at it, it says 56. Okay, so it's $56 move higher or lower. Look where we presently are. In fact, I'm even going to take this down to an intraday, 1 day, 1 minute chart. And the reason I like to do that is to just show you, okay, this is something, of course, that was drawn last Friday. Where are we right now? Basically on it. We're a rounding error. Now you're looking at a $4,565 product that missed a line, okay, that I drew on a screen, like almost a week ago. And it's uncanny how effective expected move happens to be because people, that's not just what drives order flow to the SPX. I think a lot of people kind of tune out, they're like, oh, he's talking about the SPX. The SPX drives the S&P futures. The S&P futures are driving everything in the marketplace right now, okay? The critical portion of the SPX at this point in time is we've seen what I would term a little unruly trade. This is where I say we go through these periods, again, of grandiose efficiency. Efficiency means like, look, all these weeks in a row, we're closing inside the expected move, right? Not once did we cross outside of an expected move for, 2, 3 months almost in a row. And then all of a sudden we become completely unruly. And that is, it's a breach of expected move, a breach of expected move, a breach of expected move. All right. A calm week where we only hit the lower edge, a breach of expected move. And here we are. One of the most critical things that you have to understand for the remainder of this week, okay, if we start to just bleed just a little bit higher, okay, probably very close to this high, which once again is 45.78. If we start to get above 45.78, we can just explode up on the marketplace. I know people don't want to hear that, but kind of what we, the bulls hit the bid. And this is nothing to do with people go, they're buying stock. Okay, what are they buying stock in? It's a trade. It's a dispersion trade. It's an arbitrage. When you look at this and you're like, who is out there buying Amazon, okay, at its high? Who is out there that really wants to buy Microsoft at its all-time high? You have to think very differently in today's marketplace, okay? Maybe they're buying Microsoft to turn around and actually short into other products, right? It's an arbitrage, and it has to do, okay, with gamma. It's actually almost a version of gamma scalping, okay, amongst equity products versus index products. And it's much more of a volatility dispersion trade, but nevertheless, it's a trade right now that is driving markets. And that's why I kind of call it the bulls hit the bid. By the way, that's hyphenated intentionally over there because what is causing the bid, all right, is a very wild trade. And again, it's not, this is where people start to believe it. And they're like, oh, the economy must be improving, just like they say. Yeah, because you're in a rising interest rate environment. One of the first things you learn in this business, don't fight the Fed. Don't fight the Fed. When they're lowering interest rates, don't fight the Fed. When they're raising interest rates, I go with the old adage, don't fight the Fed. Meanwhile, okay, reality can sink in. And that's when this trade ends, this dispersion trade ends, okay, when the volatility is kind of bled out of the S&Ps, which is happening in a big way over here, okay, you got big problems, which I'm going to talk about here momentarily, some of those problems. Before I get there, okay, so the SPX is dangerous right now. We need to pull back inside this expected move like tomorrow. And if we don't, okay, we stand again the risk of exploding back up outside the expected move. Look, in any given week, you want to say that, there's the higher probability of closing inside the expected move. And that is true, okay? There's a 68% chance we're going to be inside the expected move. But you got to push that aside because the lower probabilities were outside the expected move. And the lower probability is we could rip higher. So, yeah, we can coast back inside the expected move or we could rip higher. Doesn't matter. The probability, push it aside. You can say, oh, there's a 30% chance we're going to go higher. Okay. And you look at it and you go, yeah, but if we go higher, it's much higher. And that's what's a very scary premise about that. And that's why, the bulls hit the bid. Continuing on over here, bond market. Okay. This is something that's kind of falling off people's radar screen. It shouldn't. The bonds continue to rally. I mentioned this on the weekend update. The reason I'm concerned about that, like, what does it say? Okay. What does it say when you're starting to look at stuff like TYX and the interest rates are starting to drop? It's a fairly precipitous drop, right? It's from almost 4.1% down to like 3.8%. And yet the short end of the curve does what? That's staying flat or even going up. In fact, the Fed Fund futures are saying there's almost 100% chance that the Fed's going to raise rates next week. But raising rates is the short end of the curve. The long end of the curve is going down. The long end of the curve, if you look back here at this last 2 weeks, that tells a completely different story. This is like, oh yeah, we're just getting ready for the recession that's coming. Okay, how else do you read it? Well, we'll have to see. We'll have to see if the bond bid continues. If the bond bid continues, like it's almost like it's trying to price in a recession right now. Doesn't feel like it, does it? Another interesting aspect, specifically for today's trade, that I really grabbed onto is like the financials. They've been ripping lately to the upside, and the financials, they've caught fire. But the financials, okay, and the energy sector, it's kind of what just carried the S&Ps today. Nothing else carried the S&Ps. That's something to watch, is that if the financials and energy really start to bid up, and again, have a lot of respect for the fact that financials and energy is still down year to date. Financials, oh, they finally hit the positive line, a year-to-date basis. Now they're up 2%. Okay, very sarcastic with that. But the reason I'm bringing the financials and the energy, okay, are we starting to see a rotation, okay, into ugly sectors? Because finally people are done with big tech? It's a big question. Speaking of big tech, okay, one of the last things I want to bring to your attention, I want you to look, okay, at NVIDIA with me, which is up 230% basically on a year-to-date basis. NVIDIA is just a breakaway stock. One of the more alarming things in this entire marketplace really being overlooked. So NVIDIA closed right around 470, okay? And we're looking at the shortest duration options possible, okay? Shortest duration possible. And I'm going to highlight stuff that is approximately $20 out of the money. Remember, we closed right around the 470 marker. So we're at the 450s on the put side. Yep, okay? And we would look at something like, 490s on the call side. Do you notice anything? And again, I don't want to bring this to everybody's attention. Notice anything interesting about the option pricing? We're equidistant here. Okay, that means the same distance on both sides. We're $20 out of the money on the put side. We're $20 out of the money on the call side. What is unique to you? Well, okay, for the most part, what you're looking at is an absolutely phenomenal skew. Question is, how long can it last, people? The skew is inverted here, where the puts, okay, are trading for significantly less than the out-of-the-money calls. That, okay, spells danger. The marketplace, I've used this term before, frothy at this particular point in time. Something to watch over here is, sooner or later, traders, instead of trying to take advantage of this, they're going to turn around and say, you know what? We're actually going to sell the inverted implied volatility skew. At that point, it will actually reverse many of these tech stocks. For now, well, the bulls hit the bid. See how long this marketplace lasts. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.